Welcome to this guide on Ipsas 16, focusing on investment property in the public sector. This standard is vital for entities holding property for rentals or capital appreciation. We'll simplify Ipsas 16, focusing on journal entries throughout a property's life cycle. Understanding these entries ensures accurate financial statements. We'll cover initial recognition, measurement models, and rental income accounting. By the end, you'll confidently handle Ipsas 16 transactions and avoid common pitfalls. Let's dive into the practical application of these principles. Mastering these entries is key to applying Ipsas 16 correctly. According to Ipsas 16, an investment property is defined as land or buildings that are held specifically to earn rentals or for their potential to increase in value over time, what we call capital appreciation. These properties are not used in the day-to-day operations of an organization, such as for producing goods, providing services, or for administrative functions. In other words, if a property is used for manufacturing, supply chain activities, or as an office for staff, it does not qualify as investment property under Ipsas 16. The key factor in classification is the primary purpose for which the property is held. This determines how it should be reported in the financial statements. If the main intention is to generate rental income or benefit from increases in value, the property falls under Ipsas 16. If it's used for operations, it's classified as property, plant and equipment under Ipsas 17. For example, imagine a city council that owns an office building and leases out the spaces to private businesses. The council holds this property to earn rental income, so it's considered investment property. On the other hand, a government ministry building used by staff for administrative work is not investment property, since it serves an operational purpose. Sometimes properties have mixed uses, like a building with both retail shops for rent and offices used by the owner. These require careful analysis to classify each part correctly. If the rented and owner-occupied portions can be separated, only the rented parts are classified as investment property. If not, you must consider whether the owner-occupied portion is significant. Getting this classification right is essential, as it directly impacts how assets are valued and reported in financial statements, ensuring transparency and compliance. Now that you understand what qualifies as investment property, let's move on to how these assets are initially recognized in the accounts. When an organization acquires an investment property, the very first step in the accounting process is to recognize the asset in its books. This means formally recording the property as an asset, which marks the beginning of its financial journey within the company's records. The property must be measured at its cost, which includes not only the purchase price, but also all expenses directly attributable to bringing the asset to its intended use. These are costs that would not have been incurred if the property had not been acquired. By capturing these costs, the company ensures that the asset's true initial economic value is accurately reflected in the financial statements, providing a reliable starting point for future accounting. Directly attributable costs can include legal fees for the property transfer, property taxes paid at acquisition, and commissions paid to real estate agents. These are all necessary to complete the purchase and prepare the property for use. For example, if a company buys a building for $1 million and incurs $70,000 in legal, tax, and agent fees, the total cost recognized in the books would be $1.07 million. This comprehensive approach ensures nothing is left out. However, it's important to exclude costs that are not directly related to the acquisition, such as administrative overheads, general staff salaries, or unrelated travel expenses. These do not add value to the property itself. The accounting entry for this transaction is straightforward. Debit the investment property account to increase assets, and credit cash or accounts payable to reflect the outflow of funds or the creation of a liability. This initial entry is crucial, as it sets the foundation for all future accounting related to the property, including depreciation, revaluation, and eventual disposal. Getting the initial valuation right is essential because it impacts how the property will be measured and reported in subsequent periods, affecting financial ratios and compliance. Now that we've established the basics of initial recognition, let's move on to explore the different measurement models used for investment properties. Mastering these initial steps is not just good practice, it's essential for compliance with accounting standards and for presenting a true and fair view of the company's financial position. After initial recognition, choose between fair value and cost models for measurement. Fair value reflects current market conditions, with gains, losses in surplus or deficit. Cost model uses historical cost, less depreciation and impairment. Fair value offers relevance. Cost model provides reliability. Example: property's fair value increases by $150,000. Record as a gain. Cost model: depreciate over useful life, for example, $40,000 annually. Journal entry: debit depreciation expense. Credit accumulated depreciation. Consistency in model choice is key. Let's discuss rental income and disposals next. Understanding these models aids in accurate reporting. Rental income is recognized on a straight-line basis over the lease term. This means that the income is evenly distributed across the entire duration of the lease, regardless of the actual payment dates. This method ensures a consistent and fair representation of income in financial statements. Example: monthly rent of $10,000. Record as debit cash, credit rental income. This entry reflects the receipt of cash and the recognition of rental income. It's essential to maintain accurate records to ensure that all rental transactions are properly documented. Disposals occur when a property is sold or reclassified. This can happen for various reasons, such as a strategic business decision or a change in the use of the property. Proper accounting for disposals is crucial to reflect the true financial position of the business. Calculate gain-loss as the difference between disposal proceeds and carrying amount. This calculation helps in determining the financial impact of the disposal on the business. It's important to accurately calculate this to ensure correct financial reporting. Example: property sold for $2.4 million with a carrying amount of $2.03 million, gain of $370,000. This gain should be recorded in the financial statements to reflect the profit from the sale. Journal entry: debit cash, debit accumulated depreciation, credit investment property, credit gain on disposal. This entry ensures that all aspects of the transaction are accurately recorded. Accurate entries ensure correct financial performance reporting. This is vital for stakeholders who rely on these reports to make informed decisions. Let's wrap up with key takeaways. Understanding the principles of accounting for rental income and disposals is essential for maintaining accurate financial records. Understanding these processes is crucial for compliance. Adhering to accounting standards ensures that the financial statements are reliable and meet regulatory requirements. Mastering these entries ensures accurate financial statements. This not only helps in compliance, but also in presenting a true and fair view of the financial health of the business. Mastering Ipsas 16 involves correct classification and measurement. Initial measurement at cost is crucial for accurate records. Choose between fair value and cost models consistently. Fair value offers market relevance, cost model provides reliability. Correctly account for rental income and disposals. Use checklists and templates for accuracy. Understand the why behind each entry for better application. Develop a systematic approach for handling Ipsas 16 transactions. This deeper understanding aids in practical scenarios. Apply these principles confidently in your financial reporting.